Have you ever wondered how the wealthy continue to grow their money? It's not a secret, nor is it a matter of sheer luck. It's about having a well-thought-out investment strategy. Investment strategies are the compasses that guide us on our journey towards wealth creation. They provide the direction and the diversification required to navigate the choppy waters of the financial markets. Each strategy has its own set of principles, its own strengths and weaknesses, and its own way of approaching the market. Throughout this video, we'll uncover the intricacies of various investment strategies. We'll delve into the realm of diversification, explore the world of value investing, ascend the heights of growth investing, and understand the steady rhythm of income investing. Each of these strategies has the potential to create wealth, and they all require a deep understanding and a keen eye for detail. Understanding these strategies can be your first step towards financial freedom. The first strategy we will discuss is diversification. Imagine you're at an all-you-can-eat buffet. You wouldn't just pile up your plate with only mashed potatoes, would you? You'd want to sample a variety of foods to ensure a balanced meal. That's the essence of diversification in investing. Diversification is the practice of spreading your investments around. It's a technique that aims to maximize return by investing in different areas that would each react differently to the same event. Rather than focusing all your money on a single investment, diversification involves spreading your risk across different types of investments, also known as asset classes. Now, why is it important? Well, think about it. If you put all your money into one investment and that investment tanks, you lose everything. But if you've spread your investments around, the loss in one area could be offset by gains in another. Diversification doesn't guarantee profits or protect against all losses, but it does help to minimize risk. So, how can one diversify? There are several ways. First, you can diversify across asset classes. This means spreading your investments among stocks, bonds, real estate, commodities, and cash. Each of these asset classes has its own set of risks and rewards, so by investing in them all, you can potentially reduce your overall risk. Second, you can diversify within asset classes. For instance, within the stock asset class, you could invest in a mix of industries like technology, healthcare, finance, and consumer goods. Each industry responds differently to economic events, so this further spreads your risk. And finally, you can diversify by location. Investing in domestic and international markets can help protect against the risk that one country's economy may fall into recession. Remember, diversification is not about making high returns, it's about managing risk. The goal is to pick a mix of investments that has the potential to improve your overall portfolio return for a given level of risk. Remember, don't put all your eggs in one basket. Moving on, let's discuss value investing. This strategy takes us into the realm of buying stocks that seem underpriced by some form of fundamental analysis. It's like shopping for bargains at a yard sale, but instead of vintage clothes or antique furniture, you're scouring the market for undervalued stocks. Value investing is a strategy that requires patience, diligence, and an eye for detail. It's about identifying companies with strong fundamentals, such as earnings, dividends, book value, and cash flow, that are trading for less than their intrinsic value. The idea is to buy these undervalued stocks and hold on to them until the market recognizes their true worth, leading to a price increase. Now, why would a company's stock be undervalued? Well, there could be several reasons. It could be due to market overreactions to recent company news, whether good or bad, or perhaps the company operates in an industry that's currently out of favor with investors. These stocks may be overlooked, but they could be hidden gems waiting to shine. But like any investment strategy, value investing comes with its own set of risks. One of the main risks is that the market may take longer than expected to recognize a company's true value. This could tie up your investment for an extended period without any significant returns. Additionally, there's the risk that the stock is undervalued for a good reason, like a fundamental issue with the company that may not be visible at first glance. Despite these risks, value investing has proven successful for many renowned investors, including the Oracle of Omaha himself, Warren Buffett. The key to success in value investing lies in thorough research, patience, and the conviction to stick with your investment decisions even when the market swings in the opposite direction. Value investors believe that the market overreacts to good and bad news, resulting in stock price movements that do not correspond to a company's long-term fundamentals. And that, in essence, is the heart and soul of value investing. Next up is growth investing. Let's dive into it. Growth investing is a strategy that focuses on capital appreciation. Investors who employ this strategy seek to invest in companies that exhibit signs of above-average growth through revenues, earnings, or cash flow, even if the share price appears expensive in terms of metrics such as price to earnings or price to book ratios. What makes growth investing enticing? Well, the potential for high returns. Growth stocks, often being in the technology or biotech sectors, have a knack for outperforming the market when they're on a roll. Think about the tech giants we see today. Many of them were once considered growth stocks and have delivered returns that have far outpaced traditional markets. Of course, with the promise of high reward comes high risk. Growth stocks are typically more volatile than the average market, meaning the price swings can be wild and unpredictable. They're also more likely to be negatively affected by market downturns. So while you might see significant gains, you could also see substantial losses. Growth investing isn't just about picking any company that's growing quickly. It's about identifying those with sustainable growth. This requires a keen understanding of the industry and the company itself. It involves analyzing financial statements, understanding the competitive landscape, and keeping an eye on broader market trends. There's a certain thrill in investing in a company and watching it grow, but it's essential to remember that growth investing is not a get-rich-quick scheme. It's a strategy that requires patience, as substantial growth often takes time. In essence, growth investing is about believing in the future potential of a company. It's about finding those gems that are poised to become the next big thing. It's not just about where the company stands today, but where it could be tomorrow. To wrap up, growth investing is a strategy that prioritizes capital appreciation over dividends. It involves buying stocks of companies that are expected to grow at an above-average rate compared to other companies in the market. It's a strategy that can offer high returns but also comes with its own set of risks. Growth investors invest in companies that show above-average growth regardless of their share price. Lastly, let's delve into income investing. The world of investing is diverse, and among the various strategies, income investing holds a unique place. When we talk about income investing, we are referring to a strategy that focuses on securities that generate an income stream. These securities could be anything from dividend-paying stocks to bonds, real estate investment trusts, or even mutual funds that focus on income generation. Now, the appeal of income investing is quite straightforward. Imagine a stream of income flowing into your pocket on a regular basis, almost like a paycheck, but from your investments. This is what income investing offers, and it's especially alluring for those who are looking for a steady income stream, such as retirees. But it's not just about the allure of regular income. Income investing is also generally considered to be lower risk than some other strategies. This is because companies that pay dividends or bonds that offer regular payouts are typically more stable and less volatile. They are often large, established companies that have a history of generating profits, and they distribute a portion of these profits to their investors. However, as with any investment strategy, income investing is not without its risks. For instance, a company may cut its dividend if it runs into financial difficulties, or the value of a bond could fall if interest rates rise. Therefore, it's crucial to do your research and not put all your eggs in one basket. One key aspect to remember about income investing is that it's not necessarily about getting rich quick. Instead, it's about building a steady income stream over time. It's akin to planting a tree, nurturing it, and then enjoying the fruits of your labor as it matures. In conclusion, income investing can be a powerful strategy for those who are looking for a way to generate regular income from their investments. It's especially suitable for those who prefer a lower risk approach and those who have the patience to wait for their investments to bear fruit. Income investing can be a good strategy for those looking for a steady income stream. We've covered a lot today, so let's summarize. We started with the concept of diversification, an important strategy that helps mitigate risk by spreading investments across a variety of assets. This way, a downturn in one area may be offset by gains in another. We then moved on to value investing, a technique that involves buying stocks that appear to be trading for less than their intrinsic or book value. It's a strategy that requires patience but can yield significant rewards in the long run. Our third strategy, growth investing, focuses on companies that exhibit signs of above-average growth, even if the stock may seem overvalued in the short term. Lastly, we looked at income investing, a strategy that prioritizes regular income returns from investments, often through dividends or interest payments. Remember, the best investment strategy depends on your individual goals, risk tolerance, and time horizon, so choose wisely and happy investing.